Most people believe their money is simply sitting in their bank account, waiting, stored safely, available whenever they need it. You deposit money, you check the balance, and it feels as though that money is quietly sitting there for you. But here is a question most people never ask. If your money is simply sitting there, how is the bank making billions? This is not an attack on banks. It is simply how the financial system works. When you deposit money into a bank, something important happens structurally and legally. Your deposit becomes the bank's liability to you. In simple terms, the bank owes you that money. But the physical cash is not sitting in a vault labeled with your name. Instead, the bank uses your deposit as part of its lending system. Banks operate using something known as fractional reserve banking. In simple language, they keep a portion of deposits available for withdrawals, and they lend out the rest. If you deposit £10,000, the bank does not leave £10,000 untouched. A portion supports liquidity and regulatory requirements. The remainder can be used to support loans, mortgages, car loans, credit cards, business financing. Those loans generate interest, and that interest is a major part of how banks make money. For example, imagine the bank pays you 1% on your savings, but charges borrowers 5%, 6%, or even 8% on loans. That difference is called the interest spread. And that spread is one of the primary engines of banking profitability. Now here is where things become personally relevant. If inflation is running at 4% and your savings account earns 1%, if your purchasing power is quietly declining, your balance may look stable. But what that balance can buy slowly shrinks. In other words, even though you feel financially safe, you may be losing ground. Now there is another layer to this. When central banks raise interest rates, lending rates usually move quickly. Mortgage rates rise. Loan rates rise. Credit card rates rise. But deposit rates often move more slowly. That delay can widen the interest spread, which improves bank margins. Now pause for a moment. If your money is working hard for the bank, is it working optimally for you? This is where many people stop asking questions. They assume the savings account is the default, the natural place for excess cash. But institutions rarely treat idle capital this way. Large organizations constantly compare where cash can earn the most efficient yield. They review short-term instruments, government bills, money market funds, high-yield deposit products. They are always asking a simple question. Where can this capital work more effectively? Unfortunately, most everyday savers rarely make these comparisons. Not because they lack intelligence, but because the system encourages convenience. Accounts are opened, balances accumulate, and attention shifts elsewhere. Let us consider a simple example. Imagine you have £50,000 sitting in a standard savings account earning 1%. After 1 year, that generates £500 in interest. Now imagine that short-term government bills are yielding 4%. The same £50,000 could generate around £2,000 over the same period. That is a difference of £1,500 in a single year. Now extend that difference over 5 years. Assuming similar conditions and reinvestment, the gap becomes significant. This is not about chasing yield recklessly. It is about understanding opportunity cost. What could your money be earning elsewhere? And what does it earn where it currently sits? There is another important layer here. Inflation. If inflation is 4% and your savings account earns 1%, your real purchasing power declines by roughly 3% each year. But if your capital earns 4% while inflation is also 4%, you are at least preserving value. That difference becomes increasingly meaningful as capital grows. Now it is important to clarify something. Cash itself is not a mistake. Cash plays a critical role in financial stability. Liquidity protects you from panic decisions. Emergency reserves provide safety, And accessible cash allows flexibility during uncertain periods. Cash is essential, but cash is rarely designed to compound wealth over long periods. Think of cash like electricity. It powers the system, but it is meant to flow. When it stagnates unnecessarily, it underperforms. Many financially sophisticated individuals approach cash in 3 layers. First, a defined liquidity buffer. Second, working capital for short-term needs. And third, surplus capital that can be allocated into productive assets. They do not eliminate cash. They optimize excess cash. Now let us make this practical. The first step is defining your liquidity buffer. For example, imagine your essential monthly expenses are £3,000, and you prefer 6 months of financial safety. That means your liquidity target would be approximately £18,000. That money remains accessible. It is not invested aggressively. It exists to protect stability. Next, identify surplus cash. If you have £40,000 sitting in your account and your liquidity buffer is £18,000, that leaves £22,000 potentially idle. That portion may deserve closer examination. The next step is simple comparison. What interest rate is your bank paying? 0.5%? 1%? Then compare that with other low-risk short-term options available in your jurisdiction. Short-term treasury bills, money market funds, high-yield savings products, cash management accounts. You do not need complexity. You simply need comparison. The next step is aligning capital with time horizon. If you might need the money within the next year, it should remain low risk and highly liquid. But if the capital will not be needed for 5 or 10 years, the conversation changes. That capital may belong in productive assets, diversified investments, equities, or other long-term vehicles appropriate to your risk tolerance. The final step is review. Interest rate environments change. What is inefficient in 1 year may become attractive the next. Institutions review these allocations regularly. Individuals can adopt the same habit. Even a simple annual review can make a meaningful difference over time. Now let us return to the bigger picture. This discussion is not about criticizing banks. Banks are sophisticated financial institutions. They allocate capital efficiently. They price risk. They optimize interest spreads. They are doing exactly what they are designed to do. The real question is different. Are you allocating your own capital with similar intentionality? When you understand how deposits are used, when you understand interest spreads, when you understand yield efficiency, you stop participating passively in the financial system. You begin designing within it. If this shifted how you see your savings account, you might consider sharing this discussion with someone who has never thought about how deposits actually work. A simple like also helps thoughtful financial conversations reach more people. And if you would like to explore more ideas about financial architecture, subscribing helps the channel grow steadily. Because once you understand how money moves inside the banking system, you begin asking better questions about where your own capital should sit. And those questions are often the beginning of more intentional financial design.